Hello, this is Samantha Shares. This episode covers an advisory letter issued by the FDIC on managing commercial real estate concentrations in a challenging economic environment. These principles apply to all financial institutions, which is why we are sharing it here. Both were issued December 18th. The following is an audio version of that advisory and the press release. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in process NCUA examination, reach out to learn how they can assist at marktrickle.com. Also check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the advisory letter. Summary. The FDIC is issuing this advisory to re-emphasize the importance of strong capital, appropriate credit loss allowance levels, and robust credit risk management practices for institutions with commercial real estate CRE concentrations. It also conveys several key risk management practices for institutions to consider in managing CRE loan concentrations in the current challenging economic environment. Additionally, the advisory reemphasizes the importance of effectively managing liquidity and funding risks, which can compound lending risks, particularly for CRE concentrated institutions. This advisory replaces the 2008 advisory, Managing Commercial Real Estate Concentrations in a Challenging Environment, issued March 17, 2008. Statement of applicability. The contents of and material referenced in this letter apply to all FDIC supervised financial institutions. Editorial note. NCUA examiners often refer credit unions to FDIC guidance. The FDIC is issuing this letter to re-emphasize the importance of strong capital and credit loss allowance levels, as well as robust credit risk management practices for institutions with concentrated CRE exposures. Institutions with significant CRE concentrations are advised to consider the risk management principles discussed in the Joint Guidance on Concentrations in Commercial Real Estate Lending, Sound Risk Management Practices, issued December 6, 2006, and the Interagency Policy Statement on Allowances for Credit Losses, revised April 27, 2023. The advisory also identifies key risk management actions for financial institutions with significant CRE concentrations to manage through changes in market conditions. Maintain strong capital levels. Ensure that credit loss allowances are appropriate. Maintain updated financial and analytical information. Bolster the loan workout infrastructure and maintain adequate liquidity and diverse funding sources. Institutions are encouraged to continue making CRE credit available in their communities using prudent lending standards that rely on strong underwriting and loan administration practices. The full text of the letter follows. Managing commercial real estate concentrations in a challenging economic environment. This advisory to insured state non-member banks and savings associations reemphasizes the importance of strong capital, appropriate credit loss allowance levels, and robust credit risk management practices when managing commercial real estate CRE concentrations. This advisory replaces an advisory issued in 2008 that emphasized these same points during a time when CRE market conditions had weakened, most notably in the construction and development C&D sector. Previous challenging economic environments. The FDIC recognizes that financial institutions play a critical role in the economic vitality of the communities they serve by providing credit for businesses, often for CRE purposes, including real estate development. However, concentrations in CRE lending add dimensions of risk that warrant attention. CRE lending concentrations combined with weak risk management practices contributed significantly to past asset quality problems and bank failures. One example is the banking and thrift crisis of the 1980s and early 1990s. Two bank decisions to loosen CRE lending standards during the 1980s were based primarily on the assumption that real estate values, collateral values, would continue to rise in the future as they had in the then recent past. Another example is the banking crisis of 2008 to 2013, which impacted the many financial institutions that had greatly increased their holdings of, and concentrations in particular, loans to finance the development and construction of real estate C and D loans in the period leading up to the crisis. In these crises, when CRE markets deteriorated, poor management of CRE lending concentrations led to increased credit losses. Further, many CRE concentrated institutions that failed also relied on funding sources other than stable deposits and had lower levels of capital. Current challenging economic environment and real estate conditions. Recent weaknesses in the current economic environment and in fundamentals related to various CRE sectors have increased the FDIC's overall concern for state non-member institutions with concentrations of CRE loans. CRE market and lending conditions have been significantly influenced by governmental and societal responses to the pandemic, rapidly rising interest rates, and the prolonged inverted yield curve. Also, CRE investment property capitalization rates have not kept pace with recent rapid increase in long-term interest rates, which leads to concerns about general overvaluation of underlying collateral. Refinancing office and multifamily loans could be challenging in an environment of pressured rent growth, higher interest rates, and lower property values, particularly for those institutions with CRE concentrations in areas with surplus office and multifamily space. The FDIC's concern also extends to the subset of banks with elevated C and D concentrations, which subset has risen in recent quarters but remains well below the 2007 peak. Banks with significant exposure to C and D loans had substantial credit losses during the 2008-2013 banking crisis, and banks currently engaged in C and D lending could be affected by weaknesses in the current economic environment and real estate fundamentals. Managing CRE concentrations. In December 2006, the FDIC and the other prudential regulators issued concentrations in commercial real estate lending, sound risk management practices (CRE) guidance. Institutions with significant CRE concentrations are reminded that strong risk management, governance, capital, and appropriate eco levels are needed to help mitigate risks. Institutions with overall credit risk management processes that reflect consideration of the principles of the 26 CRE guidance are better positioned to manage through adverse economic environments. The principles in the 26 CRE guidance remain relevant, particularly in challenging economic environments, and particularly for institutions engaged in significant CRE lending strategies to help them remain healthy and profitable while continuing to serve the credit needs of the community. The FDIC has identified 6 key risk management actions to help institutions with significant C and D and CRE concentrations manage through changes in market conditions. Maintain strong capital levels. Capital provides institutions with protection against unexpected losses, particularly in stress markets. Institutions with significant C&D and CRE exposures may require more capital because of uncertainty about market conditions, causing an elevated risk of unexpected losses. As market conditions warrant, proactive directorates and management take steps to increase capital levels to support significant CRE concentrations and mitigate the impact of potential loss. Maintenance of an appropriate level of capital to protect an institution from unexpected losses related to C&D and CRE concentrations is an important consideration when contemplating cash dividends. Ensure that credit loss allowances are appropriate. Manage C&D and CRE loan portfolios closely. Portfolio and loan level stress tests or sensitivity analysis can be an invaluable tool in identifying and quantifying the impact of changing economic conditions and changing loan level fundamentals on asset quality, earnings, and capital. Applying adverse scenarios while conducting stress tests or sensitivity analysis helps banks adjust risk management processes, capital planning, liquidity management, collateral valuation processes, and work out procedures to prepare for credit risk problems before they impact earnings and capital. Additionally, appropriate risk management practices include maintaining a strong credit review and risk rating system 12 that identifies deteriorating credit trends early. It is important for institutions to effectively manage interest reserves and loan accommodations 14, reflecting the borrower's condition accurately in loan ratings and documented reviews. Maintain updated financial and analytical information. Bolster the loan workout infrastructure. Maintain adequate liquidity and diverse funding sources. Since liquidity and funding risks may be compounded in challenging interest rate and economic environments, it is important for institutions to have a comprehensive management process for identifying, measuring, monitoring, and controlling liquidity and funding risks. Recent industry events have underscored risks related to relying on funding concentrations, such as high levels of uninsured deposits, and the importance of robust liquidity risk management and contingency funding planning. Institutions that have identified appropriate levels of cash and cash equivalents that have identified and are able to use a stable and diverse range of funding mechanisms and that have identified and tested sources of contingent liquidity, including establishing and testing access to the Federal Reserve discount window, are better positioned to profitably support CRE concentrations. Robust credit risk management practices. Institutions are encouraged to continue making C&D and CRE credit available in their communities using prudent lending standards that rely on strong underwriting and loan administration practices. The appendix includes selected FDIC regulations, supervisory guidance, and other relevant information for additional details about matters discussed in this advisory. Refer to the FDIC's regulations, supervisory guidance, and other information for additional details about matters discussed in this advisory. This concludes the FDIC advisory letter on managing commercial real estate concentrations in a challenging economic environment. FYI, the co-author of the NCUA's Commercial Loan Rule is a member of our team at Credit Union Exam Solutions. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktreichel.com. This is Samantha Shares, and we thank you for listening.